Hello, everyone, and welcome to ClioCon 2021. My name is Rob Fromont, and I'm the Chief Financial Officer here at Clio. It gives me great pleasure today to introduce Peggy Gruenke from CPN Legal, who is going to present information on your accounting and financial performance measurements. Peggy and her team have been longtime Clio certified consultants and have assisted numerous Clio customers with their installations. Peggy, welcome. Thank you for joining us today. It's great to have you here.
Thank you, Rob. I'm happy and honored to be part of ClioCon 2021. This is actually my 8th conference, so
wow,
I think
you're
I
a
only
veteran.
missed one. Yeah. So lots of great memories.
Peggy has a lot of information for us today, so without further ado, I'll turn it over to Peggy. And then after Peggy's presentation, we'll have time for Q&A that may come up, so please enter those questions in the chat, and we'll try and get to as many as them as we can. I know there'll be lots of questions for Peggy on this, so without Peggy, do you want to take it away?
I'll take it from here. So I do have a lot of stuff to cover, so I'm going to go through slides as best as I can to make sure I do cover everything. As an overview, there's like 5 things we're going to cover. First is basic components of law firm accounting and terminology and bookkeeping. Then we're going to go over reports, which you should be generating and reviewing every month. We're going to talk about best practices for trust accounting because this is a major part of law firm accounting and making sure that everything is correct. And then we're going to get into cash flow analysis and billing and getting paid for your work. And what I want you to think about as you're listening to this topic is this is all food for thought. So after you've watched this, you can go back home, have a conversation with your bookkeeper or your accountant, and take any of these tips back with you after this presentation. So law firms are unique businesses, and they're unique in the way that we categorize things in their financial database. So what makes law firms unique? First is time billing. You don't have widgets, you're not a warehouse full of inventory, but your time is your inventory. Your time and advice are what you bill for. The other thing that makes law firms unique is this concept of advanced client costs. So you are, through an engagement with a client, fronting, so paying in advance for costs that you're incurring for filing fees or register of deeds or expert witnesses or medical records or whatever they may be. We have to make sure that in your financial data that we're tracking these expenses correctly for tax purposes, and that you're also tracking the recovery side of those expenses, which I'll refer to as billable expense income. The other thing that makes you guys unique is the use of trust accounting and retainers. General retainers aren't unique to law firms, but the trust side is. And when I talk about retainers, I do want to differentiate between a type of retainer that's put into an IOLTA or trust account, and the other type of retainer that is earned upon receipts and kept in the operating account. We have a number of clients that do general retainers and earn those as they go out through the billing cycle, but we keep them in the operating account. And the last one that makes you unique is tracking your trust activities, money coming into the trust accounts and money going out of the trust accounts. All of these components that make it unique to a law firm have to be correctly captured and categorized inside your financial software. We use QuickBooks Online. So if I refer to that, I'm referring to that as your financial software. So the first set of information, or the pieces of the puzzle, are the sections on what we call a profit and loss report. And on the profit and loss report, we're going to go through about 3 or 4 different sections. The first section is your actual revenue, your income. And I want to point out that law firms operate on a cash basis, which means revenue is realized when the money is received. And I do want to make an exception because I do have Canadian clients as well. And I know Canadians are not cash-based. They are actually what's called accrual-based. And I have another slide where I'll go into the difference between those 2 concepts. The other section that's on your profit and loss report is what we refer to as cost of goods sold. This section is where you incur the expense side of that client advance cost. So when you're paying a filing fee or expert witness, this is the type of account you're going to put that expense into to have it show up on your profit and loss report. I will point out that there is another way to record these costs, and it's an asset account, which when I get to the balance sheet I'll explain. But it's called advanced client costs, and these can sit on your balance sheet as an asset account. Um, we actually prefer. We have over 300 clients we do bookkeeping for, and we really prefer to have those expenses in the cost of goods sold section and the income up in the income section when it's realized. I do want to point out that the cost of goods sold concept or the words took on a little bit more attention this year with the PPP loans. Because when you were filling out that PPP loan, there was actually a question that asked, what was your cost of goods sold amounts? And so we had got a lot of questions about, we don't have cost of goods sold. And you actually do. So I wanted to point that out. The other one that we have in a profit and loss statement is the actual expenses. And I refer to these as firm expenses versus client advanced expenses. And these are expenses that you are incurring in the course of doing business. So you've got your normal rent, payroll, supplies, lots of different ways of categorizing expenses. And I have some samples on this I'll go through. But generally, the firm expenses is the other piece that's on your profit and loss report. We label or categorize expenses to help you better understand month by month where your actual expenditures are. And then we look for trends when we look at a profit and loss report by month to see where we're spiking on certain expenses or if everything's flowing smoothly month by month. Um, when you set up categories, or they're also called general ledger accounts, for your expenses, we do caution not to get too in the weeds on setting this up and get too detailed. We've taken on clients where they've actually set up GL accounts by vendor, like for Verizon. Well, Verizon isn't a GL account, but telephone is a GL account. So, um, and we also like to break down in firm expenses into sub accounts. So, like marketing might have sub accounts on it so that you can track how much you're spending on Google Ads, how much you're spending on your website, how much you're spending on online directory advertising, and even client appreciation gifts. So, some of the things to keep in mind as you're building what we call your chart of account, which contains all your general ledger accounts. This is the categories that are on your balance sheet. So the first one was your profit and loss report. Now we're looking at what's on a balance sheet. And a balance sheet is probably the less exciting of the two reports, but still really important. And on a balance sheet, we break things out into between assets, liabilities, and equity. So assets are something that are owned by the firm. So the cash in the bank in your operating account, your accounts receivable is an asset because that's money to be realized yet. Security deposits are a good example of an asset account. And any furniture or leasehold improvements that you make, um, they do get depreciated. So your accountant will depreciate this type of fixed asset over time based on the current tax rules. The second section is called the liability accounts. And liability accounts are loans, um, accounts payable, which are vendor bills that you owe. And the last one that might be on there is client trust funds. Oh, I should throw in there credit cards. Credit cards are also liabilities. Um, on the loans, let me take a minute to talk about loans. Loans were a big thing in 2021 because we had EIDL loans, we had EIDL grants, and we had PPP loans, right? So those three items, all of a sudden the balance sheet took on a new look because all of our firms had to add GL accounts to capture their EIDL grants, their PPP loans, and their EIDL loans. And more about that in a little bit on how to categorize those. The trust funds we'll get into in a lot more detail, but I want to just point out that on the asset side of where you have your bank accounts, you're actually going to have your trust bank account listed as an asset. The offset to that asset is the liability account, which is below. And that those two things will basically zero each other out. So keep that in mind. And then the last section on your balance sheet is your equity section. And that's your value in the assets of the firm, which include contributions made when you contribute money to the firm or net profits realized. Um, the other thing that makes up that number is if you're taking money out of your business, which we call an owner distribution instead of an owner contribution. So we've got those three components. And here's another section about your accounting method. And I want to point this out because when you're running accounting reports, it's really important to make sure you're checking the box that it's cash account style report, unless you're in Canada, where it's accrual style. And because it changes the numbers on your report when you're choosing the type of accounting method for that report. Um, the next one I want to talk about is setting up your chart of accounts. And your chart of accounts is all your categories, or we'll call general ledger, of how you're going to categorize income and expenses, assets, liabilities, and equity accounts. All right. These are general ledger accounts that are specific to a law firm. First, we have your trust bank account. This is on your balance sheet as an asset. Then we have your client trust funds or IOLTA funds. Those are as a liability on the balance sheet, which offsets the above bank account, the asset account. Then we have another income account, which we call reimbursed client expenses. When we set up our chart of accounts for our clients, we like to split out, and Clio does this beautifully with the integration of QuickBooks Online. It allows us to split out what income was part of reimbursement of expenses versus what income was actual for legal fees. So we create two separate buckets to capture those items on your P&L. And then we have your reimbursable client expenses, which is those cost of goods sold. And they are expenses, so but they're in that special area of the P&L called cost of goods sold. The last one I like to bring up because sometimes, and this might relate to flat fee clients, people that are doing a lot of flat fee work. You may have client expenses that you are not billing your client for, but you still have to expense them on your P&L. So we like to set up a GL account or category called Unrecovered Client Expenses. And these are expenses that are going to be absorbed by the firm. So they are actually on the expense side of your P&L. So accounts in summary fall into 5 categories. We got your assets account, what you own, liabilities, what your business owes to other people, and your equity, which is the difference between your assets and your liability. Those 3 categories are on one side on the balance sheet. The other 2 categories are your income, your expenses, and I actually missed cost of goods sold, so I should have added that. So if we go to the next slide, you'll kind of visually see how we break out these different accounts into different reports. And that's the difference between these. And then the cash flow statement is actually a combination of all 5 of those accounts. So now we put it all together. Here are some basic financial reports that you should be receiving and reviewing monthly. And if you're not someone that is accounting savvy or has the patience to learn it all, you really should be working with somebody who can help you decipher the data on these monthly reports to help you manage your business better. So the first one we'll go over is that profit and loss report, which is also referred to as an income statement. So it's going to show all your income at the top, what cost of goods in the middle, and then at the last section is going to be all your expenses. At the bottom of that profit and loss report is going to be your net income or profit for the month or whatever period you're running that report for. The second one we'll look at in more detail again is that balance sheet. The other report that we do generate every month that I think is really valuable for law firms to look at is your expense detail. In other words, a report that shows you by vendor or by category how many expenses you incurred that month and what those dollar amounts were. We have found this to be valuable because sometimes an expense will show up that wasn't authorized. So a lot of times we'll find credit card fraud this way if you're really looking at those expenses. Um, the trust three-way match is one of my most loved report because I love doing trust three-way matches. But that's a really important report that has to be generated every single month, and it's part of the ethics requirement. It's your own audit tool. If you ever were to get audited, you have this in your toolbox to produce to show that you have been keeping diligent track of all your trust accounting. The fifth report that we like to produce every month is your accounts receivable aging report. Now, this is a report you can get right out of Clio, all right? And you really want to keep an eye on what's 30, 60, 90, and 120 days. It's money that's on your table for you to collect. We like to avoid things getting into the 120 days. And the way you avoid that is by looking at this report every single month, all right? The other report that we produce in our monthly financial packages are the work in progress. This is your inventory. This is the future revenue that's yet to be billed. And looking at that dollar amount lets you give a little insight into what your next billing cycle has the potential of generating for your cash flow. Okay. And then the last one is the cash flow. And I got some great slides I'm going to go in to show everybody a little bit more about the concept of cash flow reports. A little side note here that we run into a lot of times on the profit and loss report. Remember that top section has your income. There are a lot of firms that like to track income differently. They may want to track income by attorney or by practice area, or if they have multiple locations, even we want to track it by location. So inside of QuickBooks, we have the ability to produce reports to split out that income into whatever categories or additional breakdown that our law firms want. So, and we actually do this do this by using data out of Clio to create what we call a journal entry in QuickBooks to break out your income into attorney practice areas or even locations. We also may have a situation where there's multiple partners in a law firm, and each partner wants their own little mini profit and loss report. To generate that, we use class codes in QuickBooks, and Clio also has a very nice feature to help us integrate class codes into QuickBooks Online. That's just a little side note, but it comes up a lot, so I wanted to throw it out there as that's a possibility in your financial reporting to help you get a little bit more better data about your business. So this here is hard to see, I know, but I wanted to show you what a balance sheet looks like. This is the asset section of your balance sheet. And your asset section has your bank accounts listed, and we break out bank accounts between what's really firm funds, which is money you have, and trust funds, which is money that's really not yours. And then we have a section called other current assets, which is that's where your security deposits would be if you put a security deposit down. Fixed assets are longer term assets that stay on the books until they get depreciated. So those will stick out there for a while. One side note that I should have mentioned a little bit earlier um, to get accurate reports and accurate data onto these reports, you have to reconcile your accounts every single month. Um, and the process of reconciling accounts does the following. It validates the data entry, makes sure expenses were categorized correctly, make sure there weren't duplicate entries, make sure all the revenue was realized correctly. Um, it confirms accuracy. Sometimes the banks make mistakes. We see where numbers are transposed when a deposit's being made and the bank teller accidentally transposes money and the wrong amount gets reported and comes over. And you won't find that unless you're reconciling your bank accounts. It also ensures that you have accurate data for tax preparation, and we're getting closer to tax preparation. So, reconciling your accounts, make sure that you're prepared for your accountant to take over and prepare everything. It also identifies irregular things. And what would be an irregular thing? It would be unclear checks, checks that you've written and that haven't been cashed, but are still sitting in in your register, um, and sometimes any deposits that might not have cleared yet, or maybe you accidentally recorded duplicate deposits into QuickBooks. That's overstating your income right now. So reconciling identifies all these errors. One thing I want to make a note about outstanding checks, because this is something we see a lot. You have to get those outstanding checks off your books around year end. We take over accounts and we see outstanding checks dating as far back as 2010, 2018, 2019. Um, and if they're trust outstanding checks, those have to be treated very special, because you actually have to reissue those checks or report them to the state as unclaimed funds. Um, the fifth advantage of reconciling your accounts is it helps control theft, um, and keeping your eye on things. A little sidetrack there, but I wanted to bring that up. So, so back to our asset account. I'm going to go to the next page, which is another view of an asset account. And this is our preferred way to produce an asset account because it shows the change. And we have this type of asset balance sheet report prepared to show the current month and then the previous period, the previous month, and then the change. All right. And so the value of this in this particular one where I have highlighted this minus 2014, that's the change in the balance of your operating account. Okay. So you can see that your operating account went down from last month. So this type of report with the previous period is sometimes advantageous to help um, pop out any problems. The other part of your balance sheet is where your liabilities are going to show up. And on the liability side, we have credit cards, which is our MasterCard up here, and we have client trust funds. So we have, my arrows got a little messed up. Sorry about that. But the money in the trust account is the $22,220. Um, this particular line here, I want to point out, we call it a bank fee reserve. This is when you open up your IOTA account and you want to seed the account with money that's not client funds, it's your personal money, you have to put it in your liability account, book it to a liability account, but it's not part of your client funds. So your three-way match will never work if you include that $25 in your client trust funds because it doesn't really exist in your client trust funds. So we create a special account for that. Down here is your equity section of your balance sheet, which shows your profit. And this retained earnings is a number that is a rolling number. So it's the profit or loss of your business from the beginning of time or the beginning of QuickBooks. So that's an interesting number to keep an eye out to. I do want to point out at the bottom here your long term liability sections. Um, by the way, credit cards are considered short term liabilities. Long term liabilities are anything that's not expected to get paid. Short term liabilities, sorry, are under a year, right? Anything over a year that's not going to get paid off or paid back is a long term liability. Okay, and they need to be accounted for on the balance sheet. So in 2021, these new accounts you're looking at here on my slide, EIDL money, this person had New York City grant money, and PPP loan. These were all brand new accounts on your balance sheet. All right. And that's where we deposited these funds as a liability because we didn't want to book $152,000 into income and overstate your income. So we had to put it on the books as a liability. Same with your PPP loan and same with your grants. We'll come into another slide where I'm going to show you now that that PPP loan has been forgiven, where we put it and get it off of your balance sheet. The other thing I want to point out is if you have something in payroll liabilities, that's something to keep an eye on because if you're using a payroll service such as Gusto or Paychex or ADP, you should not be carrying payroll liabilities on your balance sheet. You may be carrying 401k contributions or matches on your balance sheet, but your payroll liabilities really should clear out every single month. So that's something that we see a lot of hanging items in payroll liability accounts. All right, this is where, let's look at this example here. This is where, in this particular example, the EIDL grants, a lot of our firms got these grants. And when the grant was received, we put it on the books as a liability. At the end of the year, that grant needs to get removed off of your balance sheet, and we create a new account on your P&L called other income, and we called this EIDL non-taxable income. And we put it down here. And when your accountant gets your P&L reports at the end of the year, they'll know how to treat that and make sure that you don't realize it as income to the firm. All right. Now, the PPP loans, we just went through a bunch of forgiveness on the PPP loans as well. Those also have to come off this balance sheet and into other income non taxable. So I just wanted to point that out because we do see a lot of that. The way you move it from the liability account on the balance sheet to the other income account on the P&L is you use something called a journal entry. And what that journal entry does is it relieves the liability and increases the other income account on your profit and loss report. All right. Here is another view of here. Well, here's the first view. First view is your profit and loss report. This is just for 1 month, January. A lot of times we produce a profit and loss report by month. So you would see columns by month instead of just having 1 month here. Um, and the three sections we have highlighted here are your income sections, which also may be broken out into two types of income: revenue or legal fee income, and then that reimbursed expenses income, which Clio tracks so wonderfully for us. Um, the second section is that cost of goods sold. A lot of times you'll see people refer to this as advanced client costs. We call it client costs, or you might see it referred to as firm advance cost or a cost to be reimbursed. All kinds of multiple names for this type of account, but it is actually an expense account. Then below that, we see the fun part of the profit and loss report. These are all your expenses. And you're going to notice that the expenses are broken down into categories that we create. If you're working with QuickBooks, a lot of these types of categories or GL accounts come pre-canned. And then you can build upon them. So you'll notice that under advertising and marketing, we have sub accounts to track Google, Facebook ads, client appreciation, website, social media, and newsletter costs. So that's the concept behind developing a profit and loss report that's actually meaningful when you actually get around to reading it and reviewing it. Here's another view of how we broke down the sub accounts. Here's office expenses. So we break down office expenses into these subcategories. So we have a final total of what did I actually spend on office related expenses. Um, if payroll is another one. Payroll is lots of different ways to report payroll on your profit and loss. A lot of times we like to actually split out owners' wages and taxes from staff wage or employee wages and taxes, so that the owner of the firm can actually see it on their P&L what their year-to-date wages are and related taxes. Um, a note: meals. Meals for 2021 and 2022 are 100% tax deductible. That's part of the COVID Relief Act. Hopefully they keep it 100% deductible. So there's really no need to split meals up on your profit and loss report. We used to see meals split up as client entertainment, business meals, or staff meals. Meals are meals, and they're all 100%. So don't get too bogged down in dividing those up. So that's the profit and loss report. Now we're going to get into a little bit of discussion about client trust funds and how we actually correctly capture this information for accurate financial reports. When we get a call from a lawyer looking for help, our eyes immediately go to the trust account because that's where we find the most issues. um, inside people's books is the trust accounts, the transactions inside the trust accounts are not being booked to liabilities like they should be. And it tends to overstate their income and it sometimes overstate expenses. So it's really important to look at that closely. Um, and a lot of times we see that it's been done incorrectly for a number of years. And then we have our own process in place to fix that situation. But let's talk a little bit about retainers and this why they're good for business. So if we're talking here about reports, cash flow, profitability, the whole thing about understanding your business, retainers are good for business. Um, Out of our 300 and some clients that we do bookkeeping for, clients that get retainers are our most profitable clients we have. Um, they have a huge impact on your collection realization rates. And I know Clio has a lot of information about that in the new legal trends reports. Um, but you have to know how to manage these funds correctly, or you can actually get into a little bit of trouble. So there is a little bit of work to do to set it up correctly and make sure it's set up correctly. You need a good bookkeeper who understands trust accounting so it stays in good order. Um, One note on this is Clio does a wonderful job of managing client trust funds because one of the ethics rules is you actually have to show your work. So you have to be able to produce on the client. And in Clio, we include this activity on every invoice. At the bottom of every invoice, it'll show every deposit into a client's trust account and every time money was withdrawn, and then what the current balance of their trust account is. Um, you also have to maintain individual client ledgers. Um, you can actually do this in QuickBooks if you want. We don't use that method with the way Clio works with QuickBooks. We depend on Clio to keep the individual client trust ledgers. And when you see how the three-way match works, you'll understand why we do it that way. I'm going to grab a quick drink. So, what are the trust account requirements? The first one is you have to have a separate bank account set up. That bank account has to be registered with the state because any interest earned in that trust bank account actually goes back to your state. And your state might have a justice fund or something like that where they use that interest to fund those types of things. Then you have on your balance sheet a client funds and trust liability account. And I talked a little bit about those individual ledgers for clients and matters. Um, they can be it's set up in QuickBooks as well, but most of the time we just use what's in our law practice management software in Clio. Um, the last one is the monthly reconciliation and the three-way match. So this is something that has to become part of your financial checklist, your month-end checklist. Every month is to make sure that the trust accounts are getting reconciled, and you're producing what we call a trust three-way match report. And a three-way match report is called a three-way match report because we get data from three places. You look at your actual bank statements, you look at your bank register amount that's on your balance sheet, and then we look at the total of your client individual ledgers, which are actually part of Clio. And here's a little bit of look about where this data comes from. You're going to see here on the left is your balance sheet that has your trust bank account listed. And if you follow my arrow down, it's going to guide you to the liability account, which is your client trust funds. And you see those two numbers match. That's a good thing. And then over on the left here, this is a Clio trust listing report. And you're going to see over here that that number also matches the numbers that are on your balance sheet. So those are our three numbers. And we take those and we produce it into something that looks like this Excel spreadsheet. And there are tabs behind this Excel spreadsheet and macros written to actually calculate a lot of this stuff for us after we plug in data from various places. So one of my favorite tools is our Trust Story Match tool. All right, now let's talk a little bit about how we use this report, these data, to build good reports and how we collect it and organize it to help us make better decisions about our business. Um, the cash flow report is probably my second favorite report. Um, it's it's an option, it's a way for you to keep track of how much is actually in your bank account, what you're actually expending every month, what is your future revenue to be realized, and then it keeps an eye on what we call your monthly nut. Um, and if anyone is that a new terminology to anyone, a monthly nut is basically a number, a dollar number that is your fixed monthly expenses that have to be paid every month. And we look at that number and we look at what you've collected so far that month, because any collections that are above that monthly net number, that's kind of a bonus to you. That's money in the bank to you, right? Um, if their collections are below that monthly net number, that means we're falling below being able to meet those monthly expenses. And the cash flow report is a very good visual tool to use to look at that stuff. Other report that I want to mention, and I think it's probably one of the most underutilized reports that we have. It's a ratio report, and we call it a profit and loss as percent of total income. And what that will show us is what percent of your income that month or year to date or whatever periods you're running for is going to cover expenses. And I'm going to go into that in a little bit more in a minute too. And then we have a work in process report. That's our inventory. That's our future revenue. Um, Oh, I have look at utilization rates and billing goals. That's in the wrong section. I'll get to that in a minute. Um, but we're going to talk about utilization rates. Um, that is collections. We have two types of realization rates: collection realization rates and utilization rates. That can be a whole own hour conversation on its own. So I don't want to spend a lot of time on that. But the the thought behind a collection realization rate is what is really happening from the time a time entry is added to a matter through to the time it gets paid. What change has happened to that number from in that timeline? And I'll show you a little bit about what that might look like. Um, the fifth one that I'm going to throw in here is a budget report. This is a report that QuickBooks has a great tool for setting up a budget. Everybody hates budgets, um, but they actually are very valuable tools. And we have a lot of clients that work with coaches, business coaches, and this is one of the first things we put together for them is a budget that they look at every month, along with their other financial reports to keep an eye on where they're at. I'm watching my clock. Okay, here's that ratios report. Um, it's called profit losses percent of total income. And the reason I want to show you this is because what it does is it takes your income number, or actually, where's your income? Up here, 59,000. And then down here, where all your expenses are, it breaks out what percent of your monthly expense ate up that income. All right. Payroll is invariably going to be your largest number. All right. I think this is a really underutilized report. I think it's a really valuable report um, because you can visually see what percent is going where. And if you have at the bottom where we got total expenses are at 75%, that means you actually made money that month, okay? Because you eat up all your income to cover your expenses. Um, what? Oh, there we go. Well, let me switch slides. Hold on. There we go. Um, and these ratio categories, this is kind of a stand. I mean, these are just parameters, not like to set that as your own goal, but this gives you a little bit of guideline of what percentages of your income should be going to different expenses. And this is just a little breakdown. Um, of, I think I got this from a recent law firm article about accounting best practices. The next slide, Rob, and I think you'll remember this from day one. I think this was part of Jack's original opening session where we talked about, where would law firms spend additional funds? And the reason I bring this up right now is because of this percent of income, right? So if you know right now where you're spending money as percent of your income, it's going to be a lot easier for you when you get extra money or you get extra funds of deciding where you want to spend that money at. All right. So it's really good for future planning in that regards. All right. The next idea I want to get into is the value of a cash flow report. Um, A cash flow report captures about 5 or 6 pieces of data. It's your cash balance in the bank account as of a certain date. So when we run cash flow reports, it's always as a certain end date. Um, you'll be able to forecast how much money is going to be collected over upcoming weeks so you can plan. You can also forecast upcoming expenses to be paid, and you can keep an eye on your monthly nuts. All right. I can highlight here your cash is not your current online bank balance. Um, I only say that because I can't tell you how many lawyers are checking their bank balance on their phone every day to see how much money they have. Your bank balance is not an accurate number when you're looking online because your bank balance does not include those unclear checks we talked about, right? That still have to be accounted for, or any unclear deposits. So don't rely on that as an accurate number all the time. This here is a lot of stuff right here, so I apologize. But I wanted to show you what a vision of a weekly cash flow report looks like and why we love these reports. So they're produced, this one's a weekly cash flow report. We start with money. The beginning balance is always the beginning balance of your operating account. Then we capture what money came in. Whoops, sorry. What money came in, payments, and then we have an ending balance. And then down below here, we record all the expenses that happened that week to get your ending balance, which becomes your beginning balance for the new week, for the next week. And then the green columns, by the way, are weeks that already happened. The white columns are future projections where you can plug in, here's your payroll, making sure your payroll numbers are in there. It'll also show you, if you've got some extra expenditures, maybe you're doing build outs, you can plug this in here. But it'll always give you an idea where your ending bank balance is going to be based on this data we have in this report. You're going to have your credit card payments in here, paying off your credit cards. Um, so a bunch of stuff captured. At the bottom of that report is we keep an eye on your current credit card balances. Are they coming down? Are they going up? What needs to be paid off? We keep track of your savings accounts and we keep track of your trust. The last part of the uh, cash flow report shows you your month to date revenue and your monthly nut number, and if you're ahead or behind so far on your monthly nuts. So at the beginning of the month, you won't be ahead of your monthly nut unless you got early collections in, right? And that number kind of keeps growing, and eventually we want the head or the head behind number to be black, not red. All right. The other thing that I think I got cut off here on this particular cash flow report is I usually have a section that lists your current AR balance and your current WIP balance because the WIP is what's going to determine your future income in the coming weeks. All right. And I think I track cut all that under why I love these reports. A quick, this is actually a slide from, I think, 2019's Legal Trends report. Um, WIP is WIP is the top of the funnel for getting paid. I actually want to clarify that a little bit and say actually getting new clients in cases is the top of the funnel, right? But once you get that client in that new case, billing your time, getting your hours entered, being efficient with your hours is how you're going to get paid, right? So this shows how many hours, and I actually track all this for a lot of our clients. I'll show you what a report would look like, our utilization rates. But in an 8-hour day, how much is actually getting utilized, right? How many of those utilized hours are actually showing up on a bill? We call that being realized. And then how many of those hours are actually being collected, which is that collection realization report. And there's a lot of good data about that and a lot of legal trends reports. Um, so the WIP is your looking forward part of your cash flow report. The combination of your WIP and your current trust balance is revenue for particular billing for your next billing cycle. That's why we like to have those numbers on the cash flow report because we're always looking forward to what's coming up revenue wise and expense wise. Okay. Um, The other thing is utilization rates. Okay, so I'm going to go on to the next slide there. You guys can read that one later. This is a little sample of how we track hours for utilization. And basically, what we're doing here, this is all data that comes from Clio, gets pulled into a spreadsheet and calculated. How many hours did Daniel, bill? Oops, sorry, I keep clicking my mouse. Um, bill the week of February 1st, right? And out of those hours he billed, what was their time value? What was the value of those billable hours? Did he have any flat fee stuff buried in there? And then we have the utilization rate. The utilization rate is really high for Daniel. It's based on a 40-hour week. Okay. And then the last one is what money was actually collected that week in collections. And over on the right, we keep track of the month to date numbers, which is really we want to keep an eyeball on. And if you set goals, right, targets, here's your 128 hours is your monthly hours target. Are you above or behind that? And out of that 120 hours, what's the value of that? Is the 36,480. Are you past that or behind that? So this is the utilization report that's also a really great tool for helping you manage your profitability of your business. Um, the other tool that is awesome is your AR report. I don't think lawyers just don't spend any time looking at their AR reports. Maybe you guys do. Maybe we have a lot of listeners that really do look at their AR report. Um, the AR report is a great tool for your cash flow, potential revenue, but we want to actually avoid things getting to AR. So there's a couple tips I have on the next slides about how to make that happen. But when you look at an aging report, you're going to look at current 30 days, 60 days, 90 days, 120 days, is illustrated down below. And what you want to look at is you want to set a goal. Nobody should go over 90 days. You need to delegate this activity to somebody in the firm other than you as the owner of the firm because it just won't get done. All right. You shouldn't be doing it anyway. You should be billing your time. You should be getting your utilization rate up. So delegate that to somebody and stick to a schedule. So when we do collections for law firms, we have a day of the month, 20th of the month is usually around the day that we do AR follow-up calls because by then the bills have gone up, a couple weeks have passed, they need to be touched. They need to be reminded, right? And then we want to identify clients who you're still doing work for, but still owe money. Because if you're still working on people that have a large AR balance, you may want to slow down work on them or have a conversation. The last thing we want to do is talk about documenting phone calls and made and emails sent. And with Clio's great integration tools with Office 365 and Outlook, you can save emails right into the client's matter. Integration with systems like Vonage and Ring Central. You can actually have those phone calls also documented and added to Clio. Point of this little screen here is all this takes time. AR costs you money in more than one way. It costs you money because you're not getting it collected, but it costs you money to manage it. So the less time you spend managing AR, the more time you can actually be doing good lawyer work. A few tips on how to avoid unpaid bills. The biggest tool you have for preventing this is your initial meeting with your client and having a great fee agreement letter. All right. These two items together kind of set the stage to control when and how you'll get paid. I will point out that a few years ago we used to meet in person with our clients and maybe sit down and review the fee agreement together. But now with since COVID, a lot of this all happening over Zoom. And I only point that out because you really want to make sure that your client's reading that fee agreement letter and all the good content that you put in it. So one thing I want to point out is in your fee agreements and when you have that initial meeting, make sure your client understands the cost of this case and the timeline when they'll be expected to pay. Like, for example, how often do you send out your invoices? Are they due in 30 days? Are they due upon receipt? Are they due in 15 days? Also, you want to find out, do they have the ability to pay or is there going to be a third party payer? So if mom or dad is paying the legal bills for their son or their daughter, you want to make sure you document that so you know who to go to get payment, right? And that's also a little bit ethical because you can't actually share the invoice with a third party payer because that would be a violation of client confidentiality. Um, get retainers, but more importantly than getting retainers, explain to the client what a retainer is. They have no idea what a trust account is. This concept of retainer, IOLTA, these are all foreign words to them. So we want to make sure we capture that. Um, Evergreen retainers are another great thing to have in place. And with Clio's trust um, ability to create trust replenishment requests right from inside Clio, get paid, makes our life so much easier. And I'm going to skip over this because I think I'm getting close to time. This is a little snippet that shows you a little bit about what if, right? So what if you build 1,440 hours this year? And what if your current rate was $250? The value of your time is $360,000. However, we know that, I mean, if you have a 100% billing and realization rate, that's amazing. But we know that that's probably not going to happen. You're going to write down time. You're going to give a discount. Those are all things that go into your billing realization rate. So for this particular example, I assumed the 85% billing realization rate, which took that 360,000 down to 305,000. Then on top of that, how much of that's going to be collected is what's called your collection realization rate. And if your collection realization rate is at 85%, now that 360,000 is down to 244,000. That's a big difference, right? So you have lost money of 115,000. But what's even more interesting is if you look at your effective billing rate. All right, you thought you were billing at $250 an hour. After it's all said and done, looking at billing realization and collection realization, you really only billed at $170 an hour. This is a really eye-opening thing to evaluate and put on paper and hang it somewhere on your office wall so you look at it. Um, and I am getting close to time. I'm not going to spend a lot of time on this budget. I'm going to skip over that. What I want to talk about here is what are your weaknesses? Identify your weak areas, because if these are weak areas for you, then you need to delegate them to somebody else to help you make doing this better. Collections, you can delegate. Capturing your time, Clio gives you great tools for capturing time. All the integration apps we have out there to work with Clio to help capture your time. There's no reason for you not to be capturing your time. Getting invoices out the door, that is definitely something that is a weak area for a lot of lawyers. Timely. We want consistent. We want to train your clients to expect your bill the first week of the month and get it paid, right? And then use retainers. Could be another weakness of yours as well. I'm at like a 10-minute stop here, right, Rob? So I think I'm going to, this is all about billing. This is all going to be in the documentation that you're going to get, but I'm going to close out here so we have time to chat. Okay, Rob?
Sounds good, Peggy. All right, well, thank you very much, Peggy. That was awesome. Covered a ton of ground. Really appreciate you with the pro tips, like taking what's in Clio, what's in QuickBooks, what other reports you do, putting it all together, and really assimilating all that data. Like, it really makes it intuitive for people to understand, and really appreciate you sharing that with us. I've got a couple questions from the audience here, but I'm going to start with one of my own. Peggy, you covered a lot of ground there. What are the three things? I always hate asking professionals for free advice, but what are the three, the top three Peggy points of running your practice and figuring out, hey, am I making money? Am I doing the right things? Like, what are the top three things that Peggy looks at?
Billing. You got to get the bills done. We have clients that bill twice a month, even. All right. Depending on your practice areas, a lot of family law lawyers bill twice a month. Get your billing out, whether it's twice a month, once a month, just get it out consistently. get retainers. Get retainers, but only not get retainers, set the expectation that they need to be replenished when they dip down to a certain level. And that's Clio's trust management. You can use that tool in there. The other one is take credit cards in ACH payments. So important. Um, that make it easy for your client to pay, right? Make it easy for you to get paid and watch that bank account grow. When you send out those bills, click send that invoice. They have a click right there to pay online. It's phenomenal. And on the last, I know you said 3, I'm going to throw in one more. Act upon your AR report. Review that AR report and act upon it. Don't ignore it.
Well, that's great. Thanks for the bonus pro tip as well, Peggy. That's great. I've got a couple questions from the audience, Peggy. Max wants to know, if you use contractors, EGs, notaries for clients, you have them under expenses, but could that expense also be considered a cost of goods sold expense?
It could be if you're billing the client for it. Okay. The only time you're going to put it up in cost of goods sold is if you're actually going to put that expense on a client's invoice to be paid. Like if you're going to bill the client for that notary service, then you absolutely want that up under cost of goods sold.
Cool. Jennifer wants to know, for most of my expenses are in tech. Do you suggest that I make it more granular? It's significant because my overhead is otherwise somewhat low.
I would definitely break that out. Yes. Break out the technology into different types of technology. We, for example, a lot of our clients, software is a big one, right? So we may break out software into software that's related to document management, software that's related to law practice management software that's related to client acquisition. So there's different, that's how we tend to break those down, Jennifer.
Cool. Anne wants to know, do you have a resource we could use to set up formal accounting system? Is there any software that you'd recommend? And I just kind of add on to this, you know, when do you know you need an accountant to help you with this? Like what's the tipping point? You know, a little bit extending on Anne's question there.
Yeah. I will tell you, Rob, before you need an accountant, you need a bookkeeper. Okay. You have to put the bookkeeper before the accountant, because the bookkeeper is going to be the vital role in making sure your accountant has everything they need, unless the lawyer wants to be their own bookkeeper, right? Yeah. And the sooner the better. As soon as you start up your business, you should be building a relationship with a CPA, an accountant. Yeah. Not only because it's good for your business to help them help you get your books done correctly, but it also is another networking opportunity for you, right? To build that relationship. And the question, I forget what the question was from the audience.
Oh, you know, do you have a resource to use to set up formal accounting?
Yeah.
What software do you recommend? And especially if you're using Clio, what's the best one?
We've been doing this for years. QuickBooks Online is the reason. There's a reason QuickBooks is the best accounting software for businesses in the world, right? You really don't need to look any farther than QuickBooks Online for your financial software package. That's the best there is out there. We've worked with, Peachtree is one of those that are out there. I actually used to work with Xero. I was a Xero consultant for a while. I just didn't like that one so well. But to your question, you need to get something, and all of our clients use Clio and QuickBooks Online.
Well, Peggy, unfortunately, we have to shut it off there. There's a few more questions that we'll try and answer in the chat. Okay. Once again, thank you so much for this and lending the insight. You and CPN Legal have been longtime Clio certified consultants and a great assets to a lot of our customers, and we really thank you for that. And again, thank you for doing this today and joining us.
It's my pleasure. Thank you, everybody, for listening, and look forward to hearing from y'all.
Thanks, Peggy.